Hello, I'm John Conrad. Today I want to discuss the differences between an IRA and a Roth IRA, and then particularly focus on why I think a Roth IRA is the preferable choice for almost everyone. Now, almost all the documentation and literature that's out there shows why a Roth IRA is great for the very wealthy. I think it's sad and unfortunate that they really leave out how beneficial a Roth IRA is for people who are in a lower income. So if you're single and you make less than $60,000, or if you're married and make less than about $100,000, this video is really intended for you. So let me get started with what they both are, and then I'll go into the details of why I think a Roth is better. First, with an IRA, when you put money into this retirement account, you get a deduction today of the amount that you put in that account. Now, it's subject to a limit each year. On the other hand, a Roth IRA, you put money in, you don't get a tax deduction today, but that money is allowed to grow in the account, and then when you take it out during retirement, you don't pay any taxes on it, and it doesn't get included as income on your return, and that's really important, and I'll show you why later. So those are the main differences, and usually people just say, well, if you're going to be in the same or a lower tax bracket, just choose the IRA because it's better to have the deduction today. That's a better deal. And I'll show you why that's wrong. The first reason is withdrawals. So if you have an IRA and you withdraw your money before the age of 59 and a half, subject to certain exceptions, you're going to pay a 10% penalty on that money. So let's say you take out $5,000, you're going to pay an additional $500 on your money. That's not a very good deal. Now, the Roth is a real advantage here, because if you put $5,000 into your Roth IRA account, you can take out that $5,000 at any point. Now, if the $5,000 has increased because the stock market's gone up to $10,000, you can still only take out the $5,000 without paying a 10% penalty. If you wanted to take out the additional $5,000 of gain, then you would pay a penalty. But still, you're able to access the money you've put in this account without paying any penalty. And that's a huge, huge difference between the IRA. So I should also add, if you want to take out the earnings on your Roth IRA and not be subject to that 10% penalty, you have to be 59 and a half and have held the account for at least 5 years. This trips up some people because if they haven't had a Roth before and then they decide to get a Roth as they're older, they still have to hold the account for that 5-year period in order not to be subject to the 10% penalty. But if you have any Roth ever before when you're younger, you don't have to pay that penalty. So it's really advantageous even if you put in a little money to a Roth when you're young, because then you'll definitely meet that 5-year period and not be subject to the 10% on the earnings. So the next advantage of a Roth IRA over an IRA is with conversions. Now, a lot of wealthy people will want a Roth, but they won't have the ability to put their money into a Roth directly. So what they do is a backdoor Roth. And this is kind of a complicated thing that I won't get into now, and you don't really have to worry about it. But all the literature that you'll see focuses on what are called these backdoor Roth conversions. More importantly, as people who are lower income should always be looking to see if they can do a conversion from their IRA to a Roth IRA. Similarly, if their company allows it, to go from a 401k to a Roth 401k. Now, the advantage here is if you're in the lowest bracket or second to lowest bracket, you're going to either be paying 10 or 12%. Now, as you go to the next bracket, tax bracket, you're going to pay 22% or more. So what you want to do is, as long as you're in these lower brackets, convert the amount that you have in your IRA to a Roth IRA. Because frankly, it would be pretty impossible for tax rates to go lower than they are now for individuals. And then really what's happened is, at the lowest point possible, you're converting this money. And now that it's in that Roth IRA, when you take it out in retirement, you're not going to be taxed on it. The other piece to remember is when you do the conversion, you have to pay taxes from a separate account on the money that's converted. So if you had $5,000 that put into a Roth IRA account, you have to take the $5,000 and put it all into the Roth IRA account and then pay the taxes, let's say it's 10%, which is $500, from a separate account. So that can be difficult because you have to come up with that extra money. If you don't do that, then the $500 that you'd use from the conversion would also be subject to the 10% penalty. So you want to avoid doing it that way. So let me go on this final point and kind of bring everything together. So earlier I was talking about the tax brackets between 10 and 12%. Well, if you're single, that means up to about $40,000 is in this lower tax bracket. And if you're married, filing jointly, it's going to be about $79,000. Now don't forget you also have a standard deduction if you're single of $12,000, and if you're married it's about $25,000. So that gets added to here. So that's why it's about $100,000 if you're married filing jointly, and about $50,000 or $60,000 here if you're single. So the other piece to remember is as long as you are under that, when you do a conversion, the amount is going to add to your income that you've earned during that year. So you don't want to go above these amounts, or else you'll get stuck into the higher tax bracket, and that's what you don't want to do. You don't want to pay more money on this conversion. You also want to make sure that you don't want to lose some of your credits. Now I just put this one child earned credit because it's such a big one. So if your income goes up too much, you might lose some of your earned income tax credit, which you want to avoid too. So I've included those numbers here that you can look at to make sure if you're a joint filer that you don't bring your income up on a conversion above that and lose your earned income credit. Similarly, if you're a single or head of household, you don't want to bring it above this amount if you had one child, or else you could lose that credit. But as long as you don't and you stay under the limits and only pay 12% on your conversion, here's the real advantages. As I mentioned earlier, you can avoid paying tax on your Social Security with a Roth IRA. And why is that? Well, if you're an individual with your combined income between these amounts, or it's above $34,000, then you're going to be subject to 85% of a tax on those benefits. And the way you calculate your combined income is through this formula. You take your adjusted gross income, you add in non-taxable interest, and then half of your Social Security benefits. If you have an IRA, that amount's going to be included here. So it's going to make your combined income higher. That makes you much more likely to either be within this bracket where you have to pay tax on 50% of your benefits, or above $34,000 where you have to pay 85% of your benefits. And if you're married, those limits are 32 to 44, and you pay you pay taxes on half of your benefits. Or if you're above $44,000, you'd pay 85%. Now see, if you have a Roth IRA, that doesn't get included here. So the huge benefit is you stay under these limits. And if you stay under the limits, you don't pay tax on your Social Security. That's a huge advantage. Now let's assume that people are not yet 65, so they are using Obamacare. Well, the advantage with Obamacare is that there's a federal subsidy. But the federal subsidy goes away depending on your household size and whether or not you're above this 400% poverty level. So, for example, if you had income above $48,500, you're not going to get a subsidy. Similarly, if you're married, let's say you'd have a household size then of 2. If your income is above $65,000 or $66,000, then you're not going to get a subsidy. Well, if you're getting money from an IRA, that's going to add to these amounts, making it less likely you're going to get a subsidy. But if you get money from a Roth IRA, then you don't add to these amounts, making it more likely that you're going to get a subsidy. So again, that's a huge difference. It's not simply saying, you're paying more income taxes or the same amount of income taxes, but you've got to think of the big picture and really see how much you can be saving because of all these other programs that are based on your income. So with a Roth, you can keep your income lower and you can qualify for so many more savings through the government and in other areas as well. So I hope those examples help you understand whether or not this is going to be a benefit to you. One thing I would definitely suggest doing is take your tax program software that you used from the prior year and plug in your current year numbers. That way you'll really get a sense of whether or not you're going to get an advantage to doing a conversion and you're not missing out on some other tax credit or benefit that's out there that we haven't discussed. There's a lot of intricacies with taxes, but if you just play with the numbers, I think that you'll see it's an advantage for you in the end. That's all I have for today. If you have any questions or comments, please enter them below. See you next time.